Welcome to The Explainer. Today, we are unpacking a seriously contrarian thesis from our source material. And honestly, it totally flips the script on everything we've been taught about building wealth. We're talking about a deep dive analysis suggesting that the whole golden era of safe, passive investing, it might literally be over. And the real wealth shift is actually happening right in our own backyards on Main Street.
Okay, let's dive into this. The source makes a really provocative claim right out of the gate. Basically, the idea that you can just dollar cost average into an index fund, buy the S&P 500, close your eyes for 40 years, and wake up rich, they're calling it a trap for the modern investor. That classic just buy the market advice is being completely questioned because of some massive, underlying structural shifts in how public companies operate today.
And right here is the absolute core of that argument. 28%. Think about that for a second. A staggering 28% of the entire S&P 500 index is controlled by just 10 tech stocks. You know the ones: Apple, Microsoft, Nvidia, Amazon. So the analysis points out that when you buy the market today, you're not actually getting that broad, safe diversification we all talk about. Instead, you're placing a massive, highly concentrated bet that a tiny handful of mega-cap tech giants are just going to rule the economy for decades.
Section 1. The Big Lie of Safe Investing and the Underlying Market Shift.
So why is the math of public markets so broken for everyday folks? Well, look at this shocker of a data point. Back in 1996, there were about 8,000 publicly listed companies in the US. Today, that number has literally been cut in half. The public pond is shrinking fast. But meanwhile, there's this massive private ocean out there, about 25 million private businesses. And the source argues that millions of these are highly lucrative, cash-flowing, utterly boring businesses that are completely invisible to your typical index funds. And it gets worse. Because of the crazy costs and red tape of going public, ambitious companies are staying private way, way longer. By the time a hyped-up tech company finally hits your trading app through an IPO, it might already be valued at, $10 or $50 billion. All that massive 10x to 100x growth, that already happened behind closed doors for private venture capitalists. The source bluntly argues that by the time we buy in, we aren't early. We are literally the exit liquidity for institutional investors. Ouch. Section 2. 6 broke money mindsets and the psychological traps we fall into. Now, what's really interesting about this next part is,
Before we can even think about capitalizing on that private market, we have to look at the psychological traps keeping us stuck in a broken system. The source breaks down 6 broke money mindsets. You've got the martyr, who just grinds relentlessly until they burn out. The avoider, who's literally too stressed to even check their bank balance. The hoarder, who thinks stashing cash equals safety, while inflation just eats it alive. The trapped employee, totally depleted in a job they can't stand. And the apathetic, playing it too cool to care just to avoid failing. But there is one specific mindset that actively wrecks wealth in the stock market.
And that's the speculator. The source brings up this massive study of 66,000 individual investors to see how active trading actually plays out. And the results? The most active traders, the ones constantly jumping from shiny trend to shiny trend, trying to perfectly time the next wave, they actually underperform the market by nearly 7% every single year. So the big takeaway? Constantly chasing the next big thing doesn't build wealth. It actively destroys it compared to steadily building something over time.
Section 3. Buying boring everyday businesses and the strategy of Main Street acquisitions.
Okay, so if index funds are heavily concentrated traps and day trading actively destroys your money, what exactly is the alternative? The source points to acquiring cash-flowing, totally recession-resistant Main Street companies. Stuff like laundromats, plumbing services, and HVAC companies. And the crazy thing is, right now, there's a historic window of opportunity to do this. 16,000. That's the number of companies currently stuck in private equity portfolios that have been sitting there for over 4 years. Because interest rates spiked and credit tightened, these PE firms haven't been able to sell them off. So it's created this massive traffic jam of highly motivated sellers, offering a really unique entry point if you know where to look.
Section 4. The Hidden AI Goldmine and the Tiers of AI Wealth.
Now, you might be wondering, shouldn't we all just be throwing our money at the AI boom right now? Well, the analysis actually breaks the AI economy down into tiers. Up at the top, Tier 5, you have those shiny consumer-facing AI apps. The problem? They have sky-high failure rates, they burn through cash for compute costs like crazy, and if they somehow succeed, big tech just swoops in and poaches all their engineers anyway. But look at Tiers 0 through 2. This is the physical infrastructure layer. All those new data centers, they need to be built, wired, cooled, and cleaned.
The massive, beautifully boring profits are actually flowing to the local electrical, HVAC, and commercial cleaning contractors who service these billion-dollar tech hubs.
So, the crucial point is this. The source warns us to watch out for something called circular financing at the very top of the AI food chain. Here's how it works. Big tech companies invest heavily into AI startups, and then those exact same startups turn around and use that money to buy cloud services from, yep, the same big tech companies. It's basically dollars trading between tech firms, which totally clouds actual consumer demand and creates huge bubble risks at the top. This is exactly why the analysis strongly favors buying physical, boring infrastructure over those high-flying tech stocks.
Section 5. Fast business growth levers for scaling Main Street.
So let's say you take the leap. You step out of the public casino and buy one of these private, everyday businesses. How do you actually scale it? The fastest, most immediate strategy this source outlines is called the premium flip. It's incredibly simple. You just raise your prices. The analysis points out that most mom-and-pop owners are absolutely terrified to raise prices. But listen to this. A simple 20% price increase on a business doing $1 million in revenue instantly adds $200,000 in pure profit. Sure, you might lose a few super price-sensitive customers, but the source notes that actually filters out the headaches and dramatically boosts your margins literally overnight.
And this leads right into a totally different philosophy on growth. Instead of doing the slow, expensive grind of buying Facebook ads to win one customer at a time, the source talks about the rich buyout. Why not just buy out a retiring competitor who already has a massive customer list? And here is the absolute game changer. The data shows that around 60% of small businesses are sold using seller financing. That means you can literally negotiate to pay the retiring owner out of the business's own future cash flow. You can acquire entire customer bases without necessarily needing a mountain of upfront cash.
Section 6. The 7-day challenge to find hidden deals. Let's move to and see how this builds.
Because this analysis doesn't just leave us hanging with high-level theory, it provides a concrete roadmap. The first half of this 7-day challenge is all about training your eyes. Day 1, just spend 30 minutes on free business listing sites seeing what's for sale in your own city. Day 2, actively look for the ugly, unpolished listings, the ones the big private equity guys totally ignore. Day 3, get off the internet. Actually get in your car and drive down a local commercial street. Look for fading signs or those under new management banners. These are massive physical signals that a business is going through a transition and might just be ready for an acquisition.
The second half is about building your deal-making muscles. Day 4 is running the math. Actually, it's pretty simple. Most small businesses sell for just 2 to 3 times their annual profit. Days 5 and 6 are about looking up owners on state registries and getting comfortable reading basic financial summaries. And finally, Day 7. This is where you just make contact. But here's the trick. You don't pitch them. No hard sales. You literally just ask if they'd ever be open to a conversation about the future of their business. It's really just about opening doors that most people don't even realize exist. Which brings us to the final, ultimate question posed by all this analysis. The landscape has undeniably shifted, right? The public markets are shrinking and getting incredibly top-heavy, while the private markets are sitting on this massive, totally untapped potential. So, based on all these insights, which game are you going to play? Are you going to wait 40 years hoping your passive index funds survive the big tech concentration? Or are you going to start looking a little closer at that profitable, boring business you blindly drive past every single day? It is a fascinating paradigm shift, and for sure one worth exploring further.